Hey everyone, and welcome back for another deep dive. Sometimes it feels like everyone's losing their minds over something in the market, but you're sitting there like, wait, what's the big deal?
Yeah.
Well, that's what we're looking at today, this whole market dip thing.
Yeah.
And you sent over this article. It's called, Why Are Investors Overreacting to a Minor Market Correction? From the Smart Investor.
Hmm.
And it seems like even the pros are a little confused. So let's take a closer look and try to figure out what's really going on with this so-called overreaction. What do you think?
Well, right off the bat, the article makes a good point. Statistically speaking, this isn't really a crash. It's more like a correction. The S&P 500, it's down a bit over 8%, and the NASDAQ Q around 9.7%.
Okay, so yeah, that's a dip for sure.
Yeah.
But like a roller coaster dip, not a full-on drop.
Right, exactly. Historically speaking, these kinds of dips are pretty normal.
So then what's with all the freaking out? The article makes it sound like people are way overreacting to pretty typical market behavior.
Yeah, and I think to get that, we need to think about corrections not just as numbers, but also what they do to people's minds. Like, think about fear of missing out.
FOMO.
Yeah, exactly. FOMO. It plays a big part here.
So are you saying like people see these high-flying stocks? Like what were some of the ones the article mentioned?
Oh, yeah. They talked about Hoodstock and Tesla, Coinbase, all those.
Right, and those have all taken a pretty big
Oh,
hit.
huge drops, yeah. And so people pile into those stocks afraid of missing out on the gains. And then when things turn around, that FOMO turns into panic.
So it's this like exaggerated fear driven by how fast these stocks went up and then how fast they fell.
Absolutely. And we also have to remember who was buying a lot of these stocks.
Mm-hmm.
A lot of them were really popular with retail investors, newer investors who maybe jumped in near the peak. And some of them might have even been using margin or options, which can really magnify losses. So when those stocks drop, those investors feel it way more.
That makes sense.
Yeah.
So we've got this normal correction, but it's being amplified because of those dramatic drops in those specific stocks. But the article also talks about overall investor sentiment, right? Which it sounds like is pretty bad.
Yeah, you're right. The article mentions that surveys are showing only like 19% of investors are feeling bullish,
Wow.
while a huge 57% are bearish.
Oof. That's a lot of negativity.
Yeah, it is. It's actually kind of interesting because historically that kind of extreme pessimism has often happened right before the market bottoms out.
Really?
Yeah, they even mention a time late last year where we saw super low sentiment and then boom, a recovery.
Huh. So is this like a case of that be greedy when others are fearful thing?
Could be. It's definitely something to think about.
It is.
Yeah.
But there's another layer to this that the article brought up that I think we should talk about, and that's the political landscape.
Okay.
Specifically, how some Trump-supporting investors are reacting to this dip. And before we go any further, I just want to be crystal clear for our listeners. We're just talking about what's in the article here. We're not taking sides or endorsing any political views at all.
Of course. Totally objective here.
Okay, so what do the articles say about this?
Well, it seems like some investors are kind of surprised by how the market's reacting. And it might be because they had different expectations about how Trump's policies would impact things.
Interesting.
But the thing is, a lot of his policies, especially those around trade and tariffs, are pretty consistent with what he did during his last term.
So maybe this surprise comes from people not really understanding what's actually happening with policy.
Yeah, maybe. The article also talks about this idea of a Trump put.
A Trump put.
Yeah, basically it means some investors are used to seeing presidents step in and try to boost the market when it's down, but Trump seems way less concerned with those short-term ups and downs, and that's making some people nervous.
Like they're missing that safety net, and the uncertainty is adding to their anxiety.
Exactly. And the fact that this perceived put is gone just adds another layer of complexity to how people are feeling about the market right now.
Wow. So this is getting really interesting because we're not just talking about numbers anymore. We're talking about how our own biases and expectations can affect how we react to what's happening in the market.
Right. And that's definitely something to keep in mind as we keep digging into this.
For sure. Okay,
Yeah.
so to recap, we've got this market correction that seems pretty normal, but it's being amplified by fear and those big drops in some popular stocks.
Right.
And as we move forward, it's important to remember that corrections are just part of a healthy market cycle.
Exactly. The article really emphasizes that this dip, while it might hurt, is probably just a blip, not some sign of the end times.
Okay, so that brings us to the big question. How should our listeners be thinking about this whole correction? How do we avoid getting caught up in the panic and make smart choices?
Well,
Right.
One thing the article says is like a good reminder amidst all this noise,
Yeah.
It's easy to forget that investing is a long game. Like you're in it for years, maybe even decades, not days or weeks.
Yeah, for sure. It's hard to remember that when you're seeing those headlines about the market dropping or like your portfolio balance is going down.
Exactly. And that's when a solid investment strategy is so important. Like instead of panicking and selling everything off, this might actually be the perfect time to look at your strategy and see if it still makes sense for you, like with your risk tolerance and your overall goals.
So it's less about trying to guess what the market's going to do next and more about making sure you're playing the right game for your situation.
Right, exactly.
Hmm.
And one of the key parts of a good strategy is asset allocation. It's like putting together a balanced meal.
Okay.
You don't want just carbs or just protein. You need a mix to be healthy. It's the same with your investments. How you split your money between stocks, bonds, real estate, and other stuff should reflect how much risk you're comfortable with and how long you're planning to invest.
That makes a lot of sense. So this market dip, instead of being something to freak out about, could be a good time to kind of reassess that balance.
Yeah.
Like if your portfolio has shifted away from your original targets, maybe it's time to rebalance, sell some things that have done really well, and buy more of the stuff that hasn't performed as well.
Exactly. And the important thing to remember about rebalancing is it's not about chasing returns. It's about managing risk. So by getting your portfolio back to where it should be, you're basically buying low and selling high, which is what good investing is all about.
It's interesting, though, because selling something that's doing well and buying more of something that's not doing so well feels kind of counterintuitive. Like our instinct is to do the opposite, right? Like double down on the winners.
Yeah, it's definitely a mental thing for a lot of people. But think about it this way. By selling some of your winners, you're locking in those profits. And then you can use that money to buy things that might be undervalued now and have more room to grow.
So it's about being disciplined and not letting our emotions control our decisions.
Exactly. And speaking of discipline, the article also talks about another strategy that might be helpful for our listeners, and that's tax loss harvesting.
Now, that's something I haven't heard of before. What is that?
It's a way to kind of turn a negative into a positive by using your losses to offset capital gains that you might have had earlier in the year.
So, like, say I sold some stocks earlier this year and made a profit, but now I have some investments that are down. Can I sell those losing investments to, like, reduce my overall taxes?
You got it. It's a way to potentially lower your tax bill and then reinvest those savings.
Okay, I like the sound of that.
Right. And timing is important here. You want to do this before the end of the tax year to get the most benefit.
So we've got a dollar cost averaging to make our purchases over time, rebalancing to keep our investments in line, and tax loss harvesting to maybe offset some of those taxes. All great strategies to think about during a time like this. But beyond the specific tactics, there's a bigger picture here.
Absolutely. It's so easy to get caught up in all the ups and downs of the market and forget why you're investing in the first place.
All right, the article talked about that too. It's about remembering your goals. What are you working towards? Whether it's a comfortable retirement, buying a house, or paying for your kids' education, those goals should be what guides you.
Exactly. Visualize those goals. Remind yourself why you started investing. That's what'll keep you going. See this market dip not as a disaster, but as a bump in the road to getting where you want to be.
Like a financial North Star to guide you through all the chaos.
Exactly.
And speaking of guidance, I think it's important for us to remind everyone that we're not financial advisors.
Right. This is just us exploring ideas and sharing what we're learning from the article you sent us.
Exactly.
But when it comes to making big decisions about your money, it's always best to talk to a professional who can give you advice that's tailored to your situation.
Absolutely. And just to be super clear here, investing always has risks. Past performance doesn't guarantee future results, and you should always do your own research and get professional advice before making any major financial moves.
Couldn't agree more.
All right, so with all that said, let's get back to our main point. I think the biggest thing we've learned today is how important it is to keep a long-term perspective.
100%. Market corrections happen. They're part of the process. They might feel scary, but they also create opportunities.
So instead of panicking, maybe we should look at this dip as a chance to learn to adapt and to improve how we invest.
Now you're talking. And remember, as long as you're investing in good companies, keeping your portfolio diversified, and sticking to your plan, you're in a good spot to handle anything the market throws at you.
I like that. Handle anything the market throws at you. It really captures that idea of resilience and patience that you need to be a successful investor.
Yeah. It's about staying calm, making good decisions, and remembering that time is on your side.
So we've talked about how this market dip might be a chance to reassess and improve our investment strategy. And it sounds like it's not about trying to outsmart the market, but more about making sure we're in it for the long haul.
Right. Exactly. And the article you sent had some really interesting things to say about strategies to use during times like this.
Okay, let's get into that. What are some things our listeners can do to not just get through this dip,
Yeah.
but maybe even come out ahead?
Well, one thing the article mentions is dollar cost averaging. It's a simple idea, but it can be really effective. Basically, instead of trying to time the market perfectly and putting all your money in at once, you invest a set amount of money at regular intervals, no matter what the market's doing.
So like if the market's down, you buy more shares at a lower price. And if the market's up, you buy fewer shares at a higher price. But over time, it all averages out.
Exactly. And the best part about dollar cost averaging is that it takes the emotion out of investing. It helps you stay disciplined and avoid those impulsive moves that can get you into trouble.
Like it's a system to help us avoid our own bad habits, which we know can really mess things up when it comes to investing.
Exactly. And it's something anyone can do, no matter how much they know about investing. You can usually set it up automatically with your brokerage account, and it just works in the background, steadily building your portfolio.
That's great. So dollar cost averaging is one way to manage our investments during this dip. The article also talked about rebalancing, which we touched on before, but maybe we can go into more detail about that.
Sure. Remember how we talked about asset allocation? Making sure you have the right mix of stocks, bonds, and other things based on your risk tolerance and how long you're planning to invest. Well, as the market changes, that mix can get thrown off. Rebalancing is about bringing it back to where it should be, right? So if like your stocks have gone up a lot during a good market, rebalancing would mean selling some of those and buying more bonds or other assets to get back to your target allocation.
Got it. And even though it feels kind of weird to sell something that's doing well, it sounds like rebalancing is basically buying low and selling high, which is what good investing is all about, right?
Exactly. It's a disciplined way to manage risk and make sure your portfolio is still working for you and your goals.
Yeah, it's a good reminder that investing isn't just about chasing those big returns. It's also about managing risk.
Yeah,
And making sure your investments are set up in a way that makes sense for you.
absolutely. And speaking of turning negatives into positives, the article also talks about this strategy called tax loss harvesting. Have you heard of that one?
Yeah, it came up earlier. And I'm kind of curious about it. It sounds like there might be a way to be smart about our taxes here.
Yeah, for sure. So tax loss harvesting is all about using your losses to offset any capital gains you might have. So if you sold some investments earlier in the year and made a profit, you can sell some other investments that are down right now to offset those gains and lower your overall taxes.
So even when the market's down, there might be ways to make the most of our tax situation and maybe even free up some cash.
Exactly. It's like finding a silver lining in all of this. And those losses you use can also be carried forward to offset gains in the future. So it's a strategy that can help you out for a long time.
That's really cool. So we've got dollar cost averaging, rebalancing, and tax loss harvesting. All good strategies to think about during this dip. But beyond the actual tactics, it seems like the article also highlights an important mindset shift that's really key for investors, especially when things are uncertain.
You're right. It's really easy to get caught up in all the day-to-day changes in the market and lose sight of why you're investing in the first place.
Exactly. It's all about remembering your goals. What are you working towards? Retirement, a house, your kids' education. Those goals should be what drive you.
Absolutely. Keep those goals in mind. Picture them. Remind yourself why you started investing in the first place. That'll keep you motivated and help you see this market dip, not as a disaster, but as a little bump on the road to getting where you want to be.
It's like having that financial North Star guiding you through all the craziness.
Exactly.
And, as much as we love talking about all this stuff, it's important to remember that we're not financial advisors.
Yeah, this is just us sharing some interesting things from the article you sent and exploring these ideas. Right? We're here to make you think and give you some information. But when it comes to actually making decisions about your money, it's always best to talk to a qualified professional who can give you personalized advice.
Absolutely.
We want to be super transparent here. Investing always has risks. And just because something did well in the past doesn't mean it'll do well in the future. Do your own research, get expert advice, and make sure any decisions you make align with your own goals and how much risk you're comfortable with.
Couldn't have said it better myself.
Okay, so to wrap things up, I think the biggest takeaway from all this is the power of perspective. Market corrections are just a normal part of investing. They can be scary, but they also create opportunities.
Yeah, I agree. Instead of freaking out, Maybe we should look at this dip as a chance to learn to adapt and to get even better at investing.
Like a chance to build up our financial muscles and come out of this stronger and more confident.
Exactly. And as long as you're investing in good companies, keeping your portfolio diversified and sticking to your plan, you'll be able to handle whatever the market throws at you. Love that, handle whatever the market throws at you. It's a great reminder that we can get through this.
Yeah, we've got this time is on our side. And if we have a long-term mindset and good strategy, we can ride out these waves and reach our financial goals.
Couldn't have said it better myself. Well, a huge thank you to our expert for joining us today and sharing your incredible insights.
Happy to be here. Always enjoy these deep dives.
And to our listeners, thank you for being on this journey with us. Remember, stay informed, stay curious, and keep those long-term goals in mind. We'll see you next time on The Deep Dive.